One.
Good morning. Welcome to Stock Market Today. It's Thursday, January 9th, 2020. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at @Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider. It hits your inbox every trading day before the market opens. So U.S. equities, they were stronger on Wednesday after President Trump's address suggested a decline in the U.S.-Iran tensions. Technology and comm services led, while energy and utilities lagged the broader tape. Treasuries were weaker across the curve. Dollar was stronger versus both the yen and the euro. Gold ended down 90 basis points and broke a 10-day winning streak. WTI crude was down nearly 5% on the Iran news and after a surprise crude inventory build. So we get to the desk this morning. S&P futures are up about 30 basis points to start the day. Asian markets were higher overnight, led by Japan, China, and South Korea. European markets are also trading higher. Treasuries are relatively unchanged. Dollar is stronger against the yen, weaker on the euro cross. Gold down 80 basis points after snapping that 10-day winning streak yesterday. And WTI crude is rebounding a bit, up 30 basis points in the early going on a Thursday morning. So geopolitical tensions ease, sending stocks higher on the day. We actually punched through to a new all-time high before fading late in the day to end right around that 3250 resistance level that was tested yesterday. Near-term support still in the 3150 to 3200 range. The RSI does remain in bullish ranges, having pulled out of that overbought condition that we were highlighting late last week and early this week. Chaikin money flow does remain bullish, and we'll point out that on the slight pullback / consolidation, we didn't get into negative territory. So the indicators continue to confirm the price trend, which is to the upside. Market is holding above key support levels. And by our work, our shorter-term overbought, oversold indicators are now near or at oversold conditions. So to me, leading stocks, leading areas of the market, identify those stocks, identify when they're oversold, and manage your risk. We've outlined the key areas of support. We're starting to carve out resistance potentially. It's not super strong just yet. You have the playbook as far as I am concerned. No reason to be surprised in making emotional decisions in and around any headlines that might cross the tape. Leading stocks, leading areas of the market, and manage risk. What are we writing about today in our note to Chaikin Analytics clients? Well, we talked about the rebound on signs of a thaw in those U.S.-Iran tensions. Small caps are starting to lag large caps again to start the year. We'll take a look at breadth metrics, which do remain constructive, but have come in a bit on the shorter-term metrics. Large cap value becomes oversold by our work on a relative basis. That we see an opportunity there, and futures, as I said, do point to a higher open here today. Taking a look at the power bars now. For the major indices, the Dow added 58 basis points, but the power bar ratio still skewed in favor of the bears. 5 bullish or very bullish stocks for 8 bearish or very bearish stocks. S&P 500 up a like amount, 53 basis points, 120 bulls for 74 bears there. NASDAQ continues to outperform. 28-8 bulls to bears on the NASDAQ, one of our favorite areas of the market. Small caps, they were an underperformer yesterday. Yes, they did add on 32 basis points, but they lagged the broader tape by 20 basis points. 666 to 244. Bulls to bears on the power bar ratio for small caps. Bonds went lower, sending yields higher. Tech was a leading sector yesterday, up over 1%. Take a look at the technology group. 21 bullish or very bullish stocks within the XLK for 3 bearish or very bearish stocks. So tech, an area that we've liked, it's an area that we continue to like. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. Major indexes across the board, however, are mixed. Hitting our stock of the day now. Been getting a lot of questions about the aerospace and defense group because it was a market leader last year, and now it's started to underperform, but we've seen a slight pop of late when the looked like tensions were escalating in the Middle East. Taking a look at Raytheon now, ticker RTN, closed at 227.40, up 38 basis points yesterday. So a slight underperformer. RTN has a very bullish Chaikin Power Gauge rating due to very strong earnings performance. Very positive expert activity. The financials are middle of the road, as are the technicals. 20 factors, 5 in each of these 4 categories, give us that very bullish rating when we crunch the numbers overnight. Raytheon is in a strong trend. and a strong industry group. However, what I see is a very bullish stock that's outperforming the market. Money flow has been persistently positive, but a little bit more mixed of late. But really, for me, the bigger issue from a timing perspective is the fact that our short-term overbought, oversold indicator is overbought and rounding lower. Now, the stock has had a great run. It's one that we've highlighted in the past in our notes to clients. But I'm not compelled to chase it here. I think, a lot of this pop here was in and around those tensions late last week, actually a week ago. So we'll see if the stock maybe consolidates, works off this overbought condition. Certainly the type of stock that I want to consider looking at, right? Very bullish stock, leading the market, leading area of the market, a strong trend. But from a timing standpoint here and now, today, that overbought condition really kind of keeps me at bay a little bit. I think it makes sense to add Raytheon to a bullish watch list and look for an oversold opportunity, all else being equal. Added to the bullish watch list here today. Let's look at the sector tracker now. The movement of the major sectors over the last 5 days. And comm services has really been a bright spot. We've seen some of the big cap names within that group continue to work higher, and that has led to outperformance on the part of that sector. Technology continues to do well, continues to be an area that we like. Some strength in semiconductors. You know how I think about semiconductors. If semis are outperforming the market, odds are the market is going to continue to move higher. That does remain the case. We've had some bullish headlines out of the semiconductor space of late. Industrials are really starting to come on as well, notwithstanding some weakness in Boeing. Industrials, number 3 slot over the past 5 days. We talked about discretionary earlier in the week, how it was holding relative support, and the retail names were starting to work higher, getting a lot of kind of holiday updates out of some names. Best Buy reported last night, stock is trading lower. There's really a bifurcation within the retail space, and you really have to be focused on the higher quality names within that group. Healthcare rounds out the list of sectors that are higher over the last 5 days, also one that we continue to like. Financials, energy, and REITs are middle of the road, but all down over the past 1 week of trading. Staples, utilities, and materials, the bigger underperformers. But again, as I said yesterday, it's interesting to me, and if you're bullish on the kind of more cyclical call and away from the defensive areas of the market, it has played out, or it is playing out this week, with REITs, staples, and utilities towards the bottom of the list. Those are the defensive areas of the market that were leadership for a lot of 2019, and now they're underperforming. So I feel like we have the right kind of leadership to continue to take this market higher. Rotation is the lifeblood of bull markets, and we've seen a rotation really starting in the fourth quarter and continuing to play out here as the new year gets underway. Again, just to highlight the areas of the market that we like the best right now: tech, healthcare, and financials. Taking a look at our industry in focus, home builder services, and I've been getting a lot of questions about this group of late. Over the past 6 months, XHB, the home builder services ETF, has underperformed the S&P 500 by 50 basis points. It does have a strong power bar ratio, however, with 10 bullish stocks and 4 bearish stocks. It's currently ranked number 9 of 21 subsectors, and it's moved up 8 slots over the past week. Some of the names there with very bullish or bullish: Chaikin Power Gauge Ratings, M&I Homes, MHO, TriPoint, TPH, and William Lyon, WLH, are all names to take a look at and see if they warrant further consideration. The group itself, though, is the reason I'm getting a lot of questions, is I've kind of highlighted it here at the bottom, is this shift in relative strength, right? Bullish ETF power gauge rating for XHB and a strong trend above the rising long-term trend line, but we care a lot about relative strength. Remember, it's the rating and relative strength. Home builders in this group were a big outperformer throughout a lot of 2019. It was an area of the market where we were focused. However, in the November timeframe, that relative strength started to diminish, and as the new year gets underway, really in mid-December, the group has become an underperformer. Right, so not as exciting for me. Yes, there are 10 bullish stocks and only 4 bearish stocks, but I think there are stronger areas of the market where we can be focused. This is kind of a middle-of-the-road mixed bag. I want to monitor that relative strength further before really getting excited. But it was a group we liked a lot. We've kind of waned in that opinion with this relative strength falling off. I have been getting a lot of questions about it. That's why I'm glad we've had a chance to talk about it here today. I think you really need to be selective. I think there's probably better areas of the market to focus. Taking a look at what's trending now, yesterday's S&P 500 gainers and losers. Constellation Brands up 3.7% after a beat and raise. Vertex, didn't see anything company specific. Do note that the stock did trade to a new 52-week high yesterday, up 3.26%. LH got an overweight rating at Wells Fargo. That sent that stock higher by 2.77%. Some commentary out of JP Morgan sent Anthem higher by 2.65%. Didn't see anything company specific on Netflix. That stock, part of the comm services group, which has been acting really well lately, up 2.5%. Loser side of the board, Walgreens Boots. Earnings miss sends that stock lower by 5.84%. Cabot caught a downgrade, down 3.82%. Nearly 5% decline in oil doesn't help that group, that name, or any of the further names that we're going to talk about here. PSX did catch a downgrade on Tuesday. Also oil weakness yesterday. MRO caught a downgrade on Tuesday as well. Also oil weakness yesterday, down 3.74 and 3.7% respectively. Devon, nothing company specific to drive that stock lower by 3.5%. However, again, oil down nearly 5% is going to weigh on the energy complex. Remember, when oil was rallying, energy still looked bearish fundamentally. That remains the case. Got to be even more careful now if oil is beginning to roll over. Let's get into the charts now. Some of the key themes that I'm writing about in my note today. Small cap underperformance to start the year is one that has caught my attention because this is an area of the market where we started to warm up in the fourth quarter of last year, as it looked like there was a bottoming process being put in on a relative basis. IWM relative to SPY, downtrend. It's been in a downtrend for almost a year and a half, more than a year and a half, right? Small cap underperformance. What does that mean? That doesn't mean small caps weren't going higher throughout 2019. They were. They just weren't going higher to the same degree as their large cap peers. And if we take a look at this ratio, it is below a declining 200-day moving average. And RSI, while not becoming oversold, not exactly becoming overbought on these peaks either. Neutral at best, momentum, maybe a little more time needed in the basing process. We've highlighted support on a relative basis. On an absolute basis, we had the breakout through 160. I think as long as we hold above 160, we can continue to work higher. I think this breakout from this consolidation targets the 175 to 176 area. But when we're thinking about how we want to be positioned in the marketplace, when we're making decisions amongst individual stocks, it's that relative strength as a theme, right? If large caps are outperforming, well, then all else being equal, we'd rather pick the large cap name over the small cap name. Looks like some time needs to be put in place before we can base and start to work higher on small caps. Now it's Thursday. We always look at breadth on Thursdays, and breadth does remain constructive, but we are watching the short-term trends. The percentage of stocks above their 200-day moving average for the S&P 500 is still healthy, still working in line with the market after this breakout, right? So longer-term breadth confirmation. The more intermediate term, still a healthy majority of stocks above their 50-day moving averages. However, I do note after breaking through this downtrend line, we've kind of fallen back below it with the choppy trading towards the tail end of last week, early this week, right? 72% of stocks still above their 50-day moving average, right? 60% marks a healthy majority. So we still have a healthy majority of stocks in intermediate term uptrends, but we want to be mindful of changes as they're taking place. And this is a change. We're not enough to kind of get us off our bullish stance, but something we want to watch. Drilling down a little more short term, percentage of stocks above their 20-day back around the 60% mark. The advanced decline line continues to confirm the price action. So breadth does remain constructive. We're watching the near-term trends, but nothing to really shake us from our bigger picture bullish view. And here's the relative opportunity in large cap value. VOOV, Vanguard S&P 500 value, consolidating above the 50-day and 200-day moving averages as the RSI holds bullish ranges. But where we see the opportunity is on this test of the relative breakout against the S&P 500. We've had a nice work higher here in the fourth quarter, pulling back. If support holds, I think it makes sense to start to focus on some of the large cap value names because the absolute trend does remain compelling. That'll wrap us for today. Have a great Thursday, everyone. I will be back here tomorrow.